Hello, everyone. Joe Mass here. It's time for our market review of first quarter 2022 and our outlook for the next quarter and the rest of the year. Every year there's something. We've seen this slide before, but every year there's something that cools the markets down, and this year is no exception. As you can see here and know from the media, we have Russia invades Ukraine. The Fed is raising rates. We have, risk on with all the geopolitical events and inflation. So again, this year is no different. The main difference between us and an average investor is that we know this is going to happen. We don't wake up thinking that the market's going to have smooth sailing. We know there's always going to be something that comes in into the picture that we're going to have to deal with. So again, we don't know what it's going to be, but we know that we're going to have to deal with it. Okay, so we don't panic. We just know there's going to be something, and this year we have several items to deal with. Now, you guys have seen this slide before for 30 years, and right now is probably the worst time I've ever seen for investors' emotions. It's really come down to bifurcating two sides of that coin. On one side of the coin, you have risk on, fears, and people are wanting to manage risk. And of course, when you manage risk, you have to use cash and bonds and risk off assets. And of course, cash, bonds, and risk off assets don't do very well when we have high inflation. In fact, on the next slide, we're going to see that bonds are not a good diversifier to equities when inflation hits. So half our clients are worried about managing risk. On the other side of the coin, you have risk on, you have inflation, and the way you fight inflation is with risk assets, with equities, value, energy, maybe some treasury inflation-proof securities, commodities. But again, you have to take risk in order to get that return and fight inflation. So, most clients want to be on the side of the coin, right? You don't want any of the risk, you want all the return. That's the side of the coin. If you flip a coin 100 times, it's going to land 50% heads and 50% tails. It just isn't going to land on the side of the coin. So emotionally right now, it's going to be very difficult for those of you who want to fight risk with low assets, low risk off strategies, because inflation's high and you're going to have a negative real return. And then on the other side of the coin, for those of you that want to fight inflation, you're going to have to be patient and sit through that volatility. So hedging your portfolio right now is going to be more difficult than it has been in the past. As I mentioned a moment ago, here you can see that bonds and stocks are both down simultaneously, and so they're not a good diversifier. They're not providing that correlation coefficient that we used to see. Everyone's heard that bonds are up, stocks are down, and so you could balance your portfolio. Right now, they're both down. In fact, a lot of asset classes are highly correlated, and there's not a lot of safe havens, and we'll see that in the next few slides. Okay, so what's been working? Value, low volatility dividends and buybacks. Those are some of the factors that have been working. On the right-hand side, you can see the different asset classes ranging from commodities down to small cap growth. You'll see that commodities had a great quarter. Large cap value was positive, cash was neutral, and then everything else was really negative. And so, as I mentioned, there's just not a lot of places to go right now. And so even diversified portfolios are having a hard time managing that risk and providing a return. So what do? We have to maintain our process, our management style, and be patient. And we'll show you some more slides coming up. That sometimes, we can't outsmart the market. Even though we're active tactical managers and we go to cash and in and out of cash, a lot of the signals over the last quarter have been going in and out. There's been a lot of whipsaw. And so you move to cash, the market takes off, you get back out of cash. Then the market pulls back and you try to get back. So, we're holding high quality companies in our stock portfolios. And so sometimes, we just have to ride through some of that volatility and be patient. Again, we've trimmed out low quality companies. We've trimmed out high beta names. We've trimmed out things that could be suspect. It doesn't mean that those stocks can't go down. It just means we're holding high quality stocks. Another thing that we're seeing is that, coming out of COVID or during COVID, it was really the service companies that were leading. And then we saw that rotation starting to happen away from the stay-at-home companies into the service companies. And now service companies are, back to underperforming the goods focused companies. In fact, we think materials will do quite well going forward, as with the commodities, and materials are a close cousin to those commodities. Okay, so again, here what we're seeing is this chart is showing the NASDAQ 100, and it really just had its worst worst day since 2008, down 9%. And so it's definitely been a challenge. The NASDAQ companies have been struggling for several quarters now. Some companies are down, 40, 50, 60, 70, 80%. And so as the caption at the top of the slide reads, some stocks might have already had their recession, right? A lot of people were worried about stagflation, recession. Well, the NASDAQ might have already gone through its bear market and its recession, and there could be a lot of value. And we're going to look at that at the end of the presentation here on our outlook slides. But again, the NASDAQ and those companies have been hit very hard. They've probably already gone through the recession. Sometimes the saying is, it's been so bad that it's good, right? We'll talk more about that in a few minutes. So here for quarterly performance, again, what I'm showing here is growth. You can see this white line. This is the median price to sales ratio of the high growth companies. Okay, price to sales is just a measure of valuation. The lower the better. Okay, buy low, sell high. This blue line is the median prices of the Russell 1000 index. And so you'll see again that those high growth have really diverged in that valuation metric. We see it again here where the Russell high growth versus the value or the index in general is coming down. Okay, so again, that's what we saw with the NASDAQ. That story is congruent, and we're just going to have to be patient as we continue to see this secular rotation of value and growth and kind of back and forth. It's kind of been a ping pong match over the last 18 months. It's been value then growth and value then growth, service then goods, service then durables, and so a lot of moving parts. So that brings us to cycles. When we're looking at cycles, most of you know from economics that there's a slowdown, then a contraction, then a recovery, and then an expansion. At a different point to the cycle, different asset classes perform better. So during a slowdown, you see high dividend, low vol stocks do well. You see during a contraction that the buyback and quality do well. Here we see pure value is doing well during an expansion, and then down here during the recovery, momentum and large mid cap. So what we have here is we have 3 stars that are performing well, because right now the value, the dividend, and the quality dividend buyback are doing well. So why? Well, could be for 2 reasons. One, the market's always forward looking, and so the economy is still strong, right? We're still in this late expansion, right? That's the reason the Fed is raising rates. So if we're late expansion, this would make sense, but forward looking, the market might be thinking there's a slowdown or contraction that might be happening, okay? And so they may be leading us forward. Now, another possibility is that it has nothing to do with interest rates, and we're not really ahead of a recession, right? So these are the things that would usually lead us to recessions, and so there's always both sides of the coin. So we'll have to see how it plays out. On the right-hand side, you see the sectors that do well: the defensive / bond, consumer staples, real estate, utilities, and healthcare. Cyclical values are materials, energies, financials, and industrials, and those cyclical growth are communication services, technology, and consumer discretion. And we'll come back to these in just a moment. So here we see again just a chart of the things that we're working. So there's 3 things that we're working, right? Here's the 0 line, here's the red, green, and yellow line, and those correspond down to that pure value, the buyback, and the low vol high dividend index. So again, just what we saw in the prior screen, just presented differently. I think this is a nice visual to see that most things are below the line and there's only a few things above the line. So what we see here is the sector rotation versus the S&P 500. The blue section is improving, the green is leading, the yellow is weakening, and the red is lagging. Normally we see sectors rotate clockwise like this, okay? And so what we're showing is that the sectors in yellow, the consumer staples, real estate, utilities, and healthcare, they're performing well at this point in the cycle, like we saw from the other slide. Materials, energy, and industrials are also performing well, as we saw on the other slide. And the communication services, technology, and consumer discretion, right, they're lagging or weakening over here. What's also interesting on this chart is that not only does it tell us where something was, but it might give us an indication of where things might be going. So for example, here's energy over the last 10 weeks. each mark on this line is a 10 is 1 week. But look where that arrow is pointing. It's pointing down. And so we not only look at where something has been, but we're also more concerned where something might be going, right? We're trying to drive the car looking out the windshield of the car, not the rear view mirror. So again, sector rotation is making sense, and it is in line with where we had expected for this point in the cycle. Again, here we see the sector returns year to date, and here again we see the energy, consumer staples, utilities, and then really all the other sectors have been negative. Again, these are the tabular views of the returns, and the prior slide was a chart of the rotation. Okay, moving to volatility, here's our chart that you've seen before. This is risk as measured by the VIX. And what we're going to see down here is that this blue line, that's the long-term mean, right? So if you think about bell-shaped curve, that's the top of the bell. And then here's 1 deviation up, 2 deviations up, 1 deviation down, and 2 deviations down. So you will see that currently volatility at 28 is just a little bit outside of that first standard deviation. And so volatility is higher than what we've seen in the past. So what does that mean? Well, when the VIX is at 28, it means that we're expecting about just shy of a 2% move per day, okay? And so you can see that we're expecting a 1.8% move. Here we're looking at a chart of the daily returns of the S&P 500, with the green line being 1% return for the day, and the red being a down 1% for the day. And so you'll notice for the most part it's been contained, except here currently we have a breakout that's negative 2.27% for the day, which is just a little bit higher than that VIX, but we know that because it's outside of that standard deviation. So again, we're getting confirming evidence on the volatility. Here what we're looking at is the divergence of volatility on the VIX that we showed you in the prior slide and the VIX on the technology companies. So the white line is the VIX for the technology companies, and the blue line is the VIX. And so you're seeing that, again, the divergence here, and we've seen that, and we've felt that, and we're seeing that in the newspaper and our portfolios, that even the high quality tech, large cap tech companies are in that peripheral space, they are struggling right now. But again, as we're going to see, some of these long-term companies, you just have to be patient with. Okay, so the story is making sense to us. So what drives the market? Well, you've seen this slide before. Inflation, interest rate, corporate earnings, and the Fed. Markets don't like uncertainty, right? All the geopolitical events. Right now, the technical indicators are still suffering. They're being whipsawed a lot. Valuations have improved, however, and that makes sense because when the markets pull back, it creates more future value. And of course, the war, the path, remains uncertain. We don't know what's going to happen, and so there's a lot of risk out there. But let's go through and look at some of these factors. What we see here is there's the PCE at 6.4. There's the University of Michigan's survey at 3 on the white line, and the red line is the Fed's target inflation. So, I think inflation's probably peaked. It's probably going to start coming back down, and we'll probably be at maybe 4 or 5% for the next few years. I don't think it's going to be hitting its 3% long-term average quite yet, but we do expect inflation to be higher for a little bit longer here. When we look at unemployment rate, it's very low. Okay, and so everyone's working. There's lots of money. There's extra liquidity, so that's helping support inflation. We're really not seeing the velocity in the money pick up yet, but we are watching the wage inflation, and we're more concerned with the wage inflation than the PCE, because the wage inflation will have a more direct impact and a quicker impact on earnings and margins, and so we're definitely watching that. But people are working. Moving to interest rates, here's a yield curve, right? Right now it's very steep in the short end and then very flat. So it is positive, and that's a positive shape. That's good. It did invert a few weeks ago, and people were really concerned about that on the 2 and the 10 and the 3-month and the 10-year. And what's more concerning is if the yield curve stays inverted for an extended period of time, for a few weeks, for a month, for a quarter, that's when we're going to be much more concerned with the inversion of the yield curve. And remember, as you've all seen in the past, there's lots of data that shows that even when the yield curve inverts, that the market can still do well for quite some time before a recession hits, right? And even when the recession hits, stocks can do well after rates start to go up. And so It doesn't mean that the yield curve inverts and we immediately have a bear market or a recession. Again, like we showed on the prior slides, a lot of companies probably have already had their recession, okay? Now the 10 years at 2.9, so it has come up. We've always talked about the rate of change is where, is more concerning to the markets than the level. Again, we're just getting to normal rates right now, and that's a good thing, right? Having a 3% 10-year, that's normal. Getting the Fed funds rate up to, 2.5%, that's normal. So we've all been spoiled. The market's been spoiled with these low rates for a long time. So it feels like the world's coming to an end. But when you look at it historically, we're just normalizing. So, yeah, we're going through the fire. Yeah, it's painful right now, but it's, putting it in perspective, it's really just normalizing. Here's the Fed dot plot. These are the governors that vote of where they're going to have, what they're going to vote for rates, and that's the yellow dots, okay? And so you can see here by 2022, the end of the year, definitely seeing those rates come up. The green line is the median of those estimates, and the white line is the implied Fed funds target rate implied by the future. So rates are coming up. We all know that. So let's talk about, how much. Well, and how much and how many times. Back in March, on the white line, it was expected maybe a few times, right, coming into the year. Then it moved up to 6, and now it's showing, maybe 10 times between now and February 23. So that's also over the last few weeks really put a damper on the markets, and that's why we've had this severe pullback over the last few weeks, is because the market's nervous about the number of rate hikes and also the size of the rate hikes that we'll see on this next slide. So on this slide, we can see that markets are looking for 50 basis point hikes over the next 2 to 3 Fed meetings. And so here you can see the May meeting at 51, the June and July. Okay, so again, we see a lot higher rate hikes than maybe expected previously and many more of them. And that's what's the market doesn't like right now. It's putting it in a bad mood. So going to a better mood, let's look at corporate earnings. Corporate earnings are still expected to be about 17.5%. So not as good as 2021 when we were really coming off the lows of COVID, but still way above historical averages. So, for the astute observers in the audience, you'd be going, wait, if the earnings are going to do 17%, 17.5%, and we're getting 2% on dividends, man, the market should do 19.5%. And we're going to show you some evidence where that could come true. So again, all we're looking at here is here's where the trailing 12-month earnings are in the green bars. The blue bars are the expected earnings a year from now. You take the difference, subtract 1, and you get the expected return. When we're looking at how many companies have, because we're right in the middle of earnings season, so when we look at the number of companies that are reporting, right now we're seeing about 264 reporting out of 500, so a little over half. And again, 77% are beating their earnings. So it's not all bad. Earnings are, doing okay, and that's a positive thing for the market. Then when we look at corporate earnings on a global basis, as measured by the Citigroup Global Earnings Revision Index, you'll definitely see that we're starting to see those our global earnings turn negative on that index revision. So, the United States makes up what, approximately 23 to 25% of the world's GDP, and we're a very safe nation, civil with laws, and it's a safe place to put your money. So we do have a bias in the United States, even though there's a lot of value in international and emerging market companies. The U.S. is still getting a little premium for being who we are. So global earnings, and that makes sense, that are pulling back a little bit, right? Global earnings in Ukraine and Russia and other places around the world, they're having a little harder time than we are here in the United States. So what does that mean? Well, let's look at the forward-looking valuation of the market, the PE. And when we look at the S&P 500's valuation mark, again, this is just a crude measure of value, we can see that the average is about 17, and we're just a little bit above that at 19. So at the index level, it's a little overvalued. But again, within the index, there's a lot of stock selection that we can do. There's a lot of opportunities within those 500. So again, we're not going to be blindly buying the S&P 500, we really want to be focused investing, holding 5 to 30 stocks, trying to find the ones that have good earnings, that are going to survive stagflation and geopolitical events and recessions, but we might have to be patient with, okay? Now, we get a different story when we look at the enterprise value. This is EV's enterprise value to EBITDA, okay? And so here, again, we see that we're just about average, okay? Here's one deviation, two deviations above average, and here's 1 and 2 below. So you can see that we are just a little bit above, but not just barely. I'm going to call that fair value when we measure it by enterprise value to EBITDA. Okay, so we're a little overvalued when it comes to the S&P on the PE ratio, but on the enterprise value to EBITDA, we're probably fairly valued. So what's that going to mean? Well, if you look at where the market is and where analysts have it projected to be 12 months from now at 52.13, that gives you a 12-month expected return of 22%. And so that's really close to what we saw from the expected earnings and the dividends. Okay, so I'm not saying that we're going to go up 22%, but when the market at the beginning of the year we were expecting 7 to 9, and when the market pulls back like it has, you add that together, and you can see that that is a reasonable expectation. Again, doesn't mean that we don't go down another 10 or 20% from here, but from a valuation perspective, there is some potential return. Okay, looking at the technicals, we see a pretty good story here as well. What we've done down here on this line, this is the forecast of the market done prior to the year, and you'll see that it's really mirrored the year pretty well so far. Now, there's no guarantee that it continues up like this, and you can see that it isn't a straight line, that there is some ups and downs, there is that volatility in the market, but the general direction by the end of the year is in a positive upward sloping fashion, which is a positive return, and that corresponds to the expected return expectations. So again, this no guarantee of the future, but both the fundamental data and the technical data give us a little bit of hope. We are a little bit more bearish, than we have been. So we are bullish, but not as bullish as we were. Again, we have a lot to get through. We do, the Fed, the rates, the war, geopolitical events, the election. There is a lot going on. So I'm not saying that it's all rosy and sunshine and we're just going to go up, but there are pockets of hope, and it's really, like we've been talking about, probably going to be looked back on as an inflection year 10 years from now, where this year was, we have a lot going on. We have the end of the bond bull market, starting the bear market. Rates are going up, inflation's going up. There's a lot going on right now. So patience is going to need to be deployed. And on this slide, what we're going to look at is some drawdowns. Everyone's really worried about drawdowns. We like to avoid them as well. But I just want to point out, here's Microsoft. Microsoft is one of everyone's favorite stocks, and since the mid 80s until current date, it's averaged annual return of 26%. So people love to own Microsoft. But what they forget is that there was a long period of time, over 2,000 days to go down 72%. And then it took another 1,400 days to go back up and break even. So that's a long time. That's 14, 15, 16 years there where this was a flat stock and you had a lot of drawdown before the run up again. So again, as good as Microsoft is and as much as we like it, you have to remember that sometimes you have to hold these good companies through some of these downturns. Okay, here we're looking at Amazon. It's the same thing that we saw. We saw 455 days to go down, 94%. Then it took 2,000 days to go back up. We've also seen a 36% annualized return. Here we see that the earnings don't seem to make sense. However, they do, because Amazon was reinvesting those earnings to get the growth out of the company, right? And so we know that story. So there's a lot of this happening in the current companies and these new tech companies that sometimes you're going to have to be patient for them. We don't want to just blindly hold the drawdowns, but sometimes you have to be patient with high quality companies, the world-class companies that have world-class, managers, because if you get out of them and you're trying to outsmart the market, which we can't do, and time it perfectly, a lot of the time you miss that recovery, right? You can see that the market recovered pretty quick once it hits the bottom. It recovered pretty quick. It recovered pretty quick. And so sometimes if you're holding high quality companies, you just have to be patient and let the story come true. So one more stock here, Apple, the same thing. You see a 23% return annualized, but you see some erratic earnings. You see a great drawdown, a steep recovery. Okay, Steve Jobs comes back, and earnings really pulled the stock up. But look at along the way, you still have these drawdowns. So again, it's just interesting that some of our favorite stocks that have produced exceptional returns over the long run, at any given week, quarter, day, or year, they could have a drawdown. And so We can't avoid every drawdown. We definitely try to avoid the major ones the best we can. But again, at the same time, we have to hold some of these quality companies and be patient with them. Okay, let's talk about the outlook for a few minutes. Here we're looking at the sentiment chart from the AAII, U.S. Investor Sentiment. And so what you'll notice here is that it's pretty low, 43%. It's only had a couple other times, right back there in March of 2009 and back there in the 90s there. 54 was as low. And so again, sometimes when the sentiment is so bad, it's good, right? But right now, the sentiment is definitely low. The market has definitely pulled back, as we've seen in prior slides. And so that can give you some hope that, I don't think we're out of the woods yet, but it can give you some hope that things may be getting close to the bottom, okay? Now, looking at the next slide, what we see here is S&P 500 breadth. And you have two breadth measures on this chart, one in green and one in purple. One is the percentage of members within the S&P 500 that have their price above a 50-day moving average. And then the purple is above the 100-day moving average. And so anything above 50 is good. Anything below 50 is bearish. And so we're still below 50. So it's still a bearish indicator. So we're not out of the woods yet. And, again, we still think there's some volatility left in the year. But we are hopeful that the end of the year does turn around. So the breadth is telling us that we're not quite out of the woods yet. On this slide, we're looking at the S&P 500 favored technical indicator year to date, which is the Williams R. So what we do is we don't, predefine some fancy byline or a bunch of indicators that always, tell us the secret sauce. The indicators are always changing. So what we do is we observe what's working, and then we, take the ones that are working and use those in a special way. So here what we're looking at is that if you wanted to have traded the S&P 500 year to date, the best way to do that is measured by both the Sharpe ratio and total return would have been Williams R. And so what you see here is that we're definitely in that oversold range. Now, a market can stay oversold for a while, like you've seen here and here and here, okay? But again, when things get so bad, they could be good. We're definitely looking at an oversold condition. And when the market breaks back up through this line, or that white line breaks up through the green line, that's an indicator, that's going to be marking maybe the turnaround. So again, this can stay down for quite some time, but it does give us a little bit of hope that we are oversold, and it looks like there's room to go up. It could go down much further, but it does give us hope that the bottom might be in or very near. Again, with geopolitical events, you never know. So, that volatility spike that we've been seeing in the VIX can continue to happen on those headline news. But right now, based on the Williams R indicator, it does look to be oversold, and we would have some hope in that indicator. We look at the next indicator. This is on the NASDAQ 100, and its favorite indicator year to date would have been the Rex oscillator. And so here you can see that, again, the NASDAQ's a little more confused than the S&P 500. That white line did break back up through the red line, okay? So that was a positive sign. That's what we want to see. But again, it turned back down. So that's what I mean. There's a lot of whipsaw going on, right? We get a signal that says get back in, then we get a signal that says get back out, then back in, and then back out. But again, we do see that based on this Rex oscillator, the market was trying to turn back up. Okay, so we'll just have to be patient and wait and see. So on this slide, what do we expect? Well, we're kind of bullish on U.S. equities, international and emerging markets, except for we're probably neutral across the board because there's just so much uncertainty right now. We just have to wait to see how these interest rates and inflation, corporate earnings, geopolitical events, and the Fed plays out. But there is value in equities, in all equities, U.S., international, and emerging markets. From a valuation perspective, there's some really good deals out there. It doesn't mean that they're going to materialize overnight, but there's definitely some value. And you typically want to be buying at the peak of fear and pessimism and selling at the peak of greed. So right now, it looks like the world's coming to an end, and historically that's the time to buy. So that makes us bullish, but we are definitely less bullish than we have been, and there's so much noise in the market right now on top of the high frequency trading. We're just neutral until we can get a better, more clarity or better read on the market as data continues forward throughout the year. Fixed income, yeah, definitely, we're bearish on that. The rates are coming up. Now we're trying to take advantage of that by shorting the market in some of our portfolios, and our individual bond portfolio has a great yield. So for people coming into that portfolio now, it is positioned very well against the index. However, it is fixed income, and we'll have a negative real return if inflation stays at 7%. Real estate, we're neutral on. Typically, hard assets are a good asset class to be in when you fight inflation. However, right now, rates have come up. We wrote an article on this a couple weeks ago. Rates have come up from, so fast between the beginning of the year and now that, it's like the people buying $800,000 houses are going to have to buy $600,000 houses. And so, real estate markets in certain areas probably have to adjust downward of 30% to get back in equilibrium. So there's probably some pressure there, although it is a good long-term asset class, historically speaking, to fight inflation. So, going forward, we expect lower long-term returns. Obviously, fighting risk and inflation is at the forefront. Interest rates are probably going to be between 1.5% and 3%. Obviously, the bond purchases are stopping. The Fed is starting to unwind their balance sheet by selling the balance sheet, as well as raising rates. So we definitely think there's an increased opportunity here for active tactical management and in asset allocation. Our asset allocation portfolios have been doing very well to limit the risk, and the sailboats, which are our most tactical portfolios, are actually been even positive at certain points of the year or flat. So that risk management and asset allocation may be popular again. Volatility's been just a little bit above average with these spikes around the news events. Okay, so again, it's above average now. It's above that 1 standard deviation point, but prior to that, it's been kind of trading in a range of normality with these spikes around major events. Hopefully, we'll see this, calm down in the second half and start to equalize in the second half of the year. So again, like we said, risk management again is popular. Corporate earnings are stronger than in the past, stronger than average, but we're still really watching those margins and the growth rates along with that wage inflation. So what do? Hold enough cash to make you comfortable, right? Evaluate your time horizon and other factors that go into your investment policy statement. And really, time is probably one of the more important factors right now. Over the next 3 to 6 months, who knows? But over the next 3, 5, 10 years, I'm pretty sure equities are going to prevail. Okay, so you're going to have to be patient. You always want to look at your 2 objectives, your risk objective, your return objective, and then you want to look at your 5 constraints, your time horizon, your taxes, your liquidity, how much money do you need within the next 12 months, right? Any legal issues and special unique circumstances that you may have. So communicate your changes. If any of your objectives or constraints have changed, please let us know and we can help reposition the portfolios. Again, we have about 30 portfolios, so that there's always something going to be working, and we just got to make sure that our portfolio selection is in line with your goals and objectives. So you're going to have to be a little bit patient right now. What do? Well, don't try to overmanage. We can't outthink the market. We're not smarter than the market. So sometimes we just have to be patient until we can make good decisions. We don't want to make decisions without strong and confirming evidence. So just to make a decision isn't a good decision. So again, we're trying to keep up with going in and out of cash and in and out of shorting the markets and the appropriate portfolios. May is a rebalance month, so we will be rebalancing all the portfolios, or most all the portfolios this month, and we'll be incorporating all this new data into it, as we continually do. So we will monitor and adjust, and we will communicate as we have in the past. Again, if there's been any changes in your goals or objectives, please let us know. Again, we thank you so much for letting us serve you. We really appreciate it. Luckily, we find these times exciting. We have passion for this, so we're happy to be here paying attention to this for you, and we really appreciate that opportunity. So with that,